investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. I'm starting off with the CBOE Market Volatility Index, aka the VIX. And as the VIX is inversely related to the S&P, it's a good idea to keep this on your watch list as a leading indicator. And we'll start right here. So you could see that obviously the VIX moved up this week. It did not move down. And one thing you cannot control are the tweets that President Trump puts out. And what shook the markets up today, right from the get-go, was his announcement that he was going to increase the tariffs on Mexico to the tune of 5% and continue to increase until they put some kind of a ban or at least get immigration under control, especially with the illegal immigrants crossing the U.S. border. So while I don't agree with the timing of this announcement, I will say that I'm in good company. It didn't look like the investors were too happy with that. So we saw a spike in volatility, but it wasn't too bad, actually. We have a spinning top here as the volatility index is reaching for resistance, which is where it hit early in the month, right on May 9th, right there. So a couple of other things. We have the spinning top as it's approaching resistance. I think we could move up next week to test that resistance and then ultimately pull back. And the reason I think the VIX could pull back is because if I back out here, you'll see that the stochastics oscillator is a great indication for overbought, oversold. But with the VIX, it rarely goes over the 80 on the scale from 0 to 100. So you can see that in the past, there was only one other time this year, maybe twice, that it breached the 80 mark. And so we are approaching 80. And I think what we'll see is the stochastics start to pull back along with the CCI. And that would result in a drop in the volatility index, but ultimately what happens, a rally will ensue because they're inversely related. So now that I've said that, let me erase the forecast from last week. By the way, none of the technical signals panned out the way we thought they would, and there's a reason for that, and I'm going to get to that when we talk about the Dow. But the volatility index is inversely related to the S&P, which leads us to the S&P. You can see that we have a wide divergence from the 20-period moving average. The market does not like to stay that far below or above. As a matter of fact, you have that rubber band effect taking place. So if the VIX is expected to go up and test resistance, I think early on we could see a little bit of a drop. But ultimately, I think we're going to eventually get back up to the 20-period moving average. May not even be next week, but I think that that will ultimately happen. You can see that the stochastics is extremely oversold and starting to lay flat. I think that will start moving up, and that will ultimately cross the %D, which is that red line, and creating a buy signal right there. Another thing I want to point out on the S&P, or the spiders here, is that we have 6 red candles in a row. The last time that we had that happen, we were following with a long stretch of green. Rarely does the S&P move 6 or 7 days in a row, all one color. So I think we could actually see a reversal here in the price action next week because of that stale red light and the stretch of that rubber band, and we have gaps above the market. So you have to be very cautious because you don't want to take too heavy of a long position, because what we could see is capitulation in the market, especially if President Trump is not easing up on his rhetoric with regard to tariffs and trade wars and such. That shakes up the investment community, and investors really are not liking that all too much. Now let's go to a more broad-based index. In the Russell 2000, you can see it's the same story all over again. We are at a key support level right here. I'll just extend that out just a little bit so you can get an eyeball on that. And I think we could, again, pull back to that 20-period moving average. We did not do that this week, so I'm going to erase that line, and I'll just leave the forecast just like that for next week. So that's a Russell 2000. If I look at the Qs, this is the NASDAQ market basically showing the tech sector, same story all over again. We broke out below that support level, so that support level is now going to act as resistance, and so will the 20-period moving average. So I'm going to erase these lines and show you that we are at, again, we're approaching a key support level for the NASDAQ. The rubber band is stretched here as well. We have stochastics extremely oversold with the possibility of it crossing and creating a buy signal. And so next week, while I still think we could go a little bit lower on the NASDAQ, I think ultimately we're going to wind up a little bit higher next week and maybe get some relief over the weekend as investors more or less digest the news and get a handle on their emotions and what's happening with the trade relation between Mexico, China, and others in the world. So that is the Qs. Now, I'm leaving the diamonds for last because there are some signals that you have to pay very close attention to. We are right on a support level. We almost closed above it today, but we're right at it. Notice back here, and I'm going to erase this so I can redraw it. There's a gap down below the market right here. You see this? So gaps fill 80% of the time. So the diamonds could actually drop a little bit to fill that gap. And then we're expecting a bounce because 80% of the time after a gap fills, it reverses and goes the other way. So that's point number one. The rubber band is being stretched right there. Stochastics are extremely oversold. But here's what I want you all to pay very close attention to. While I am expecting a bounce next week up to the 20-period moving average, long term, I've turned extremely bearish, and here's why. If you look very closely, this is the monthly chart. Today, as I record this, it's the last trading day of May, and we closed May right here with an enormous bearish engulfing pattern. This is something you cannot ignore because if you look back, each time we had a bearish engulfing pattern, the market went lower. And this was back in December, and before that, we had a bearish engulfing pattern in October. All right, so that's the bearish engulfing pattern, and we're seeing it on higher volume. Now, on a weekly chart, I want you to pay very close attention to what could be a head and shoulders top. Here is the left shoulder, here is the head, here is the right shoulder. This is a critical part of how to build a head and shoulders top, is that the volume on the right shoulder needs to be lower than the volume on the head. And we're seeing the drop in volume on the right shoulder. The only thing that we have left to complete this head and shoulders pattern and call it an actual top is we're going to have to see a drop in the neckline. Now, this is an elongated trough here, so the neckline is more or less going to be drawn from these lows, but you could also use this low as a key support level for the head and shoulders. So what I'm saying is, if this turns out to be a head and shoulders pattern, watch out below. Yesterday, I put out an alert to our Option Oracle subscribers to do a put spread, which is a bearish strategy in CMG. Hopefully, every one of our members got into that because CMG dropped about 17 points today on the technical signals. So individual stocks are doing very well reacting to signals. If you did not get in on that and you're a subscriber, then don't worry. There's going to be other trades in the future, especially bearish trades to capture profits if, in fact, we do top out with a head and shoulders pattern. So these are my forecasts for next week, along with my, I would call it a yellow flag right now. We're not waving a red flag, but we are definitely waving a very large caution flag for anyone thinking about loading up on long positions. I wouldn't do that right now. We are now starting to reverse into bearish strategies across the board for our subscribers, and hopefully you're using good risk management principles. If you'd like to learn more about what we do at The Market Guys, just go to the Market Guys website. That's marketguys.com. Click on the video tab right there, and I'd like to direct your attention to the 1% rule, which is right here off to the left. and you want to make sure that you are looking at the head and shoulders top. That's a very short video. I've talked about that already, and it'll give you a better understanding of what a head and shoulders top is and how to define it and even how to trade it. So hopefully that'll help you. Have a great weekend, and we will talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.